Zach, I don't know if you remember, but in 2021, 2022, and 2023, the banks were going crazy. They were lending way too much money, and now people are paying with huge amounts of negative equity.
All right, Pops, like you said, back in 2021, 2022, and 2023, these banks extended their loan-to-value ratios and gave money to a lot of people to buy a lot of cars at overpriced values. And now today, we have the latest data from our Q4 negative equity study, and holy cow, man, things are bad. I'll just tease this, Dad. Half of the people that own electric vehicles in the United States right now are upside down on their auto loan. But before we get into the data that we were able to collect in partnership with Black Book, explain to us what loan-to-value ratio is and what these banks did back in 21, 22, and 2023 that set us up for this disaster that we're currently in.
So you want me to explain loan-to-value? It's simple. Let's say there's a car that has an actual value of $10,000. And banks back in 2021, 2022 were saying typically if you had really, really good credit, they might lend 125% of loan to value. So if the value was $10,000, they would agree to lend an additional $2,500, $12,500 against that vehicle based on credit. Well, during 2021 and 2022 and into 2023, banks were lending 150, 160, 170% of loan to value. So if somebody bought that $10,000 car and the bank was willing to finance an additional 70% of its value, meaning they'd write a loan for $17,000 on that $10,000 vehicle, well, what do you think's going to happen the minute you sign the loan and you drive off the lot? You are at minimum $7,000 upside down.
Now, at the exact same time, we know that used car values were going through the roof. They were being overvalued, and new cars were selling over MSRP with dealer addendum stickers and things like that. Pair that with banks being willing to and happy to lend at 150, 160, 170% of loan to value ratio, and you end up in the situation we're currently in right now, which is the worst negative equity crisis we have ever seen and skyrocketing auto loan delinquencies. This data comes from the CarEdge Q4 negative equity study in collaboration with Black Book. 39% of drivers who have financed a vehicle, Dad, are currently in an upside down position. They owe more on their car loan than what their vehicle is worth. That is up from 31% in Q3 of 2024. Electric vehicles are the hardest hit. 54% of EV owners who finance the purchase of their electric vehicle are underwater, up from 46% in Q3 of 2024. We also have 60% of drivers overestimating their vehicle's value, 18% overestimate their vehicle's value by more than $5,000, and 7% of respondents overestimate their vehicle's value by $10,000. 84-month loan terms are screwing customers, Dad. The median negative equity for someone that holds an 84-month car loan is $8,485, while 36-month loan terms have positive equity of $7,783. And Tesla, Kia, and Jeep owners are currently facing the steepest negative equity, whereas Toyota, Subaru, and Ford owners are in better financial positions. Whoa, man, these numbers are shocking. And I'm not saying that in my typical hyperbolic sense. This is insanity.
Oh, it is indeed. And I can assure you that when I was active in the business, I must have dealt with every one of the 18% and 7% who overestimated the values of their vehicles quite a bit. Because I confronted negative equity on a daily basis with people trying to trade cars in. And when you have large amounts of negative equity, it prevents you from moving forward, making another purchase, unless you have lots of money to put down. Well, if they had lots of money to put down, they wouldn't be in this negative position to begin with. So it creates this cycle of where people get in way over their head, and every time they try to get out, they dig themselves into a deeper hole. And looking at the numbers compared to Q3, it is staggering to me the direction that we seem to be going. And I know car sales are up in December. That's great. Long term, they're going to fall because there's way too many people who are in a position where they can't afford to get out of the vehicles that they have, who might actually want to get out of those vehicles.
We started this video by talking about loan to value ratios and how the banks were complicit in this situation that we're currently in. Banks are also complicit in the rise in the average loan term length. The average loan term length is north of 70 months right now, 69 to 70 months. And you see what happens here. The longer you stretch out your loan term, the more likely you are to be in a negative equity position. Think about the swing debt. It's a $15,000 difference in terms of your equity position from an 84-month to a 36-month. And let's talk a little bit about how folks who may be in a negative equity position can kind of navigate this situation. And for next time, or if you're contemplating purchasing a vehicle, how you can be educated and informed so you don't end up in this situation. And maybe, Dad, we'd be remiss not to talk about it. Gap insurance. What the hell is it, and why is it important in the context of this video?
Well, gap insurance is insurance that covers the difference between what is still owed on the car and what an insurance company would pay for that car if it were totaled. You know, if you owe $15,000 on your car, but it's only worth $10,000 to the insurance company, well, there's that $5,000 gap that you would remain responsible for. Gap insurance covers that for you. So many people who find themselves in negative equity positions should make sure that they include gap insurance in their auto loans. Now, how banks were complicit in this is, they just kept extending loan terms. You can actually get auto loans up to 96 months. Imagine how buried those people are. And the only way to combat negative equity like this is, A, you stay in the car that you have longer than what you might have intended so you can decrease your negative equity, or B, you come to the table with more money down.
I also think it's worth mentioning, Dad, just because the bank approves you for 72, 84, 96 months doesn't mean you should take that loan term. That's a big theme here. Next time I go to purchase a vehicle, just because I can get approved at that length doesn't mean I'm going to take it, because all of the data suggests that if I do that, I'm going to be putting myself in a financially difficult situation a year down the line, 2 years down the line, 3 years down the line, hell, through the entire term of that loan. Not only am I paying more interest over the term of that loan, I'm also just setting myself up for failure in terms of the vehicle's value versus my loan balance. So I think that's a good takeaway for our community as well, is just because you get approved doesn't mean you need to take that loan.
And if you do fall into, I'll take that longer term, know in your heart of hearts that you should try and double up on payments wherever you can, or make some principal payments during the term of that loan so that you can bring the payoff down quicker. There's nothing wrong with taking a longer term if you're willing to increase the amount of the payment you actually are making to the bank.
Now, I want to share one other piece of information that came from Edmunds' most recent study on negative equity. 22% of vehicle owners that have negative equity are more than $10,000 upside down, and 7.5% of vehicle owners who have a negative equity position are upside down by more than $15,000. So not only are we seeing more people, more consumers who finance the purchase of their vehicle in a negative equity position, we're also seeing a staggering amount of negative equity. 1 in 5 over $10,000 upside down, 7.5 out of 100. More than $15,000 upside down. These are big numbers, folks, and there are going to be lasting implications and ramifications in the industry as a result. We have the data that CarEdge collected in collaboration with Blackbook linked down below in the top of the description. Go ahead, click on it. You can see how every different automaker stacks up in terms of negative equity and so much more. All that information is available for free. Just click the link in the top of the description or Google search CarEdge negative equity study. Dad, thanks for making this video. It's like a public service announcement, man. Please be smart out there, folks. This is damning stuff that we're looking at.
Well, thank you for allowing me to do this. And yes, this is part of our continuing effort to educate the public as to what to look out for.